think it's officially time to. We're live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB rental property of the week. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC, because he's got genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And on the ones and twos, producing in the background, is our community manager, our marketing superstar teammate, Madison. Welcome to the show, Madison.
Hello, everybody.
Good to have you. And today we have a guest investor. He's a longtime fan of the show. He's has the best record of anyone attending the show, and it's me. I'm the guest investor today. We're going through my properties. Like, I don't even know how to interview myself. But for right now, I just want to welcome you, friend, on the podcast who isn't joining us live, and let you know that it is as fun as it sounds if you tune in live, nyais.com, Tuesdays and Thursdays. Come join us. Come hang out. If you're listening to us on the radio, listen to us on the podcast, come hang out so you can meet our friends in the roll call. Y'all ready for the roll call?
Game on.
Absolutely.
Roll call. Let's go. Jen Filson says happy birthday at JWB family. Fairy godmother of the Not Your Average Investor Show community. Drew Barnhill says, good day, everybody. Leo Furaganan. Leo, man, I got to work on that last name of yours. He says, good morning, all. Welcome, Leo. Madison is checking in the chat as well. Lee Bishop says, hello, Pablo in the hot seat, and Greg hosting with the lovely Madison on board. MVP of the Not Your Average Investor Show community. Nadeem Shah. Hi, everyone. Good morning. Good afternoon from the West Coast. John Henning. Good afternoon, all. Ken Moline, the patriarch of the first family of the Not Your Average Investor Show. Good morning from California. We got Greg Stone saying howdy from New Jersey. Good to see you, Graham. We got Sir Peter James from the great Commonwealth of Virginia. Welcome, Sir Peter.
Esteemed guest.
Esteemed. We got Joanna in the chat. She's back as well. Who else we got? We got Greg wishing everybody a happy St. Patrick's Day. Happy St. Patrick's Day, everybody. And Marilyn Cotterman saying Pablo. Marilyn is from Homosassa, Florida.
That's the home of the manatees, if anybody was wondering.
The manatees. Joseph Divine or Devine. Let me know, Joseph. I'm thinking Divine based on the spelling. First time listener, first time dialing in. Joseph, welcome to the show. Happy to have you here. Marie Rockoff from Scottsdale, another newbie, or at least first time checking in. Marie, good to have you.
Just out there. Love me
That's
some
right.
Scottsdale. Was just out there for the Waste Management Open a month or so ago. Wonderful time out there.
Yeah, man. Yeah, and we got Bill Shields with us. Buenas tardes, amigos. Buenas tardes, Bill Shields. Good to have everybody in. Madison, we have a new segment, which is Madison shares good news. Madison,
Yes.
what do you got for us
all
today?
the good news. So not a lot of people know, but a few years ago, we implemented a thing, I'm going to call it, for you guys when you put houses under contract and you close, to be able to donate to our JWB Cares. Super easy to do. All you have to do is sign your closing paperwork if that's what you choose to do so. So just in this last few weeks, we have had some awesome investors, clients, some you know, some are new, which is awesome to see, donate $500 towards JWB Cares. So I am giving them a little shout out. Lori put 2 houses under contract, $100 for each house you put under. Was donated to JWB. The first family, Ken and Carolyn Moline, everyone knows them, everyone loves them. They put also 2 properties under contract and $200 towards JWB Cares. And then we had Roberto and Jessica close on, I believe, their first property, correct me if I'm wrong, and they donated $100 as well. So super cool. See that you guys shared the same goal we do, is helping the community.
It's amazing. It's like this whole thing comes for full circle, right? You're doing right by residents out there. You're doing right by the community out there. You're doing right by our clients out there. And then in turn, our clients are doing right by the community, the residents, Jacksonville, a greater mission of solving affordable housing crisis. Like, it is just like a beautiful thing. And Madison, great job sharing all that stuff, right? I love this new segment. What's it called? Madison shares good news.
Madison shares good news.
I think it's here to stay.
It's going in my Facebook bio.
Here to stay. Working title. I think it's adopted. Let us know in the chat. Is it called Madison shares good news? Think of a great name in the chat. Like we say, this is a crowd generated show. You bring the value as much as we do. And all right, let's get started with the show. GC, last thing, that JWB Cares, where it's all going. What is that all to Canines for Warriors? Is that for like a group of charities? Where does the JWB Cares fund go?
So JWB Cares is our charity, and the mission here is to solve affordable housing and the biggest way that you all kind of know us for solving that problem is through our home donation each year. So we just had our JWB Charities Golf Tournament, which raises money, and all of that money goes towards building a brand new home that we then we donate to a member of the Jacksonville community. And we partner with great organizations. And the one that we partner with to choose that recipient is Canines for Warriors. And we choose a veteran who could use a helping hand in affordable housing. So all of the money that you would decide to donate goes directly to JWB Cares. And all of that money goes towards building a brand new construction home and giving it away to a veteran who needs a helping hand. And our mission continues to grow more and more. The first year, through all of our year's effort, all of that previous year's effort, we raised $32,000, and we're able to give that to Canines for Warriors. In just 4 years since then, we raised over $150,000 just last year. That puts us over $350,000 raised in total, and 4 homes donated so far to members of our military who could use a helping hand. And we want to go bigger, and we want to do more. And we would love all of your help. So if anybody would like to help support, it's just as simple as letting our team know. The next property you'd like to put under contract, you just say, yeah, I'd like to add $100 as a donation. The next time you do a private loan with us, hey, I'd like to add $100 to that donation. Or if you just like to donate whenever you want to, you can go to jwbcares.org and help us support this mission. And we just thank you very much from the bottom of our hearts. It's really special to all of us.
And now, GC, it is time for real estate education. Let's whisk ourselves away to the property of the week. I am optimizing here for sharing. Let me know how it looks. Tell me in the chat if it's fuzzy or not, but we are magically whisked away to 720 Locust Street, Jacksonville, Florida, 32205. Purchase price of $290,000, 4-bedroom, 2-bathroom, 2-car garage, lease of $1,668, and the what we really look for here, which you'll hear from me as I'm the guest investor, is this $51 per month in total monthly conventional cash flow and estimated conventional financing total ROI of 7.16%. GC, what do you like about this property?
Well, I thought you'd never ask, brother.
I don't always ask.
There's a lot to love about this property. We can talk about returns, we can talk about cash flow, but even greater than those things, the thing I love about this property is that it is available. And you are hearing me beat this drum about how availability is one of the most important parts of a property right now, because frankly, there's just such a lack of inventory in the marketplace. And if you joined us for the client only call and you joined us for the real estate market update last week, we talked about how what is going on, the bigger picture dynamics of the real estate world and the construction world are kind of coming together, and it's going to squeeze that inventory even smaller in future months. I do expect there to be a waiting list for those who want to invest in JWB properties coming in some amount of weeks. I estimated 2 to 8 weeks, a week ago. So sometime soon, there is going to be a waiting list. So if you are on the fence and you are thinking that real estate or investing in rental properties with JWB might be the right call for you sometime in the next 3 months, 6 months, 12 months, I would highly encourage you to focus right now your energies on deciding if buying this property or buying a similar property right now is the move. Because frankly, if you make that decision in 3 months or 6 months, I think you're going to have to wait, and nobody likes to wait. So availability is the big thing. I want to keep you guys updated. What I shared was prior to this waiting list, JWB is opening up 40 properties from our company inventory to kind of smooth the transition, not to surprise any of you out there that there will be a waiting list at some point. And so I just wanted to give you an update. We're down to 29 properties. So 11 has sold, and that number is going to continue to go down. So again, availability is the most important thing at the moment. Of course, we want to make sure that our cash flow and returns always hit our criteria, but availability is going to be the biggest thing that's going to change, in my opinion, and it's going to change quickly. So that's the first thing. The second thing is this thing that you kind of talked about, Pablo, and I'm so glad that you're the guest investor today, because part of the reason you made your decision to buy your two properties is because each of your two properties came with what we call a buyer credit, right? Buyer credits are amazing. They're not normal, right? This is where you buy the property, you have these expected returns like we're talking about. And in addition, you also receive a credit at closing. And so the buyer credit at closing for this property here on Locust Street is $3,144. That means when the client who buys this property closes on the property, they immediately make $3,144. And that is a great way to start off your return on your investment and give us an opportunity to overperform for the property. We can go a little bit more into why that is and why that makes sense for JWB to do here as we go through the property of the week. But those are my top two reasons why I love this property.
Awesome. So as guest investor, my first head goes to, why are you giving me $3,100 to buy this property? Is there something wrong with it?
Well, that's a great question. And there's nothing wrong with this property. In fact, there are a lot of things that are right about this property that you don't get in a normal rental property investment at this point. The number one thing being that it is already rented, right? Remember, this is coming from JWB's company portfolio. We're really good at buying assets and keeping them rented, right? That's what we do for all of you. We got to be good for ourselves. So this home is one of my properties. It's one that we're making available. It has been rented for years. It's rented right now. But this home, looking at where the market rents are today versus the last time we signed a lease and a lease renewal with this resident, the rent has gone up. The market rent has gone up. And so when you see a buyer credit, that's an example of JWB looking at it and saying, okay, well, in order for us to sell this property and deliver the right amount of cash flow and the right amount of return on investment, and for us to sell it at the right price, well, we need to make sure we make up that difference for our client. And so right now, technically, this property is rented $131 per month less than what market rent is. And so when that happens, we give that credit for a period of 2 years. We give that to the buyer, set them up for success. It's not only for the buyer here. What it allows us to do is to hit our return expectations, allows us to sell at market value as well. So this isn't only altruistic, but it's a win across the board for everybody. And so if you take $131 and multiply that times 24, that gets you to $3,144, which is your buyer credit for the person who buys this property.
Sounds good, buddy. All right. That's an attractive proposition that they're in there getting a deal, but you're making the investor whole through it. And it's a win-win for everybody, which I've obviously learned that is the way that you operate. I want to encourage you all two things. If you're listening to the podcast, go to jwbinventory.com to download this sheet, because you can mess with the cells and the quantities and do whatever you want. Normally on these guest investor calls, we'll spend up until about the 1 o'clock hour talking about the property and into the investor story, which in this case, it's going to be me. As I look at this thing, a couple of things pop out to me. Since we've started showing these like fresh out of the JWB portfolio properties, I really like the idea that this thing is a 2017 house. It's kind of like that mixture between new construction and remodel that didn't have any new work done to it right now because it was just built. It's rented and you guys have owned it for some time. Do you see that as like some kind of like better product, this like hybrid kind of new construction thing, or is it all the same?
I think it's all the same. I think it's all the same, right? We sell homes that were built in 2022. We sell homes that were built in 2017. We sell homes that were built in 1950, right? The way that this thing works internally for JWB is that our standard needs to be met no matter what type of vintage the house is, right? No matter what the age of the house is, right? The standard needs to be met. Now, the standard is different for maintenance costs for a new construction home, right? Built in 17, you're going to notice that your maintenance costs have a certain standard. And that is a different standard than if the home was built in 1950, because based on our historical data, right, we see that you have slightly higher maintenance costs for a home that's built in 1950. But that standard for a renovated home built around 1950 needs to be met, just like the standard for a 2017 build needs to be met as well. So I'll get out of generalities and get into specifics here. So for a 2017 home, right, we're looking at your maintenance rate here. That's saying that each year you should plan, you should set money aside. You should be prepared that you're going to lose about 4% of the rents collected in terms of maintenance cost. It's not going to happen that same amount every single year, but over time, it's going to average to about 4%, right? Now, on the renovation side, if I was to put a home that's 1950 build in front of you, that maintenance rate is 7.5%. And that probably makes sense to all of us, right? Older homes, things break a little bit more. Is it egregious? No, right? But it's one of the benefits of new construction is that you're going to have slightly lower maintenance costs. You're going to have slightly higher maintenance costs on renovations, but there's a lot of advantages to renovations as well, right? You're going to have lower purchase prices on renovations, whereas on new construction homes, you're going to have higher purchase prices, which, you know, offsets the positive of lower maintenance costs. So there's pros and cons. I don't think that people should be buying this property specifically because it's a 2017 build or because it is JWB owned versus non-JWB owned. I mean, it's great that you guys see that we obviously believe in this asset and have owned these, and we own over 300 of them. But I think this home meets the standard. The standard is the standard across the board. Everything I put in front of you should meet that standard. And that, so I'm not overly excited just because of that. Sorry to burst your bubble.
All right. That's fine. I won't take it personally. We got a couple good questions here in the chat. So Nadim's got a question. He asks, if and when JWB starts a waiting list, how will it be decided who goes on the list first, second, third, and so forth down the list? And how long will the waiting period be?
Great questions. It will be on a first come, first served basis, right? So once our inventory is exhausted, once we bring clients to the point where they are fully onboarded and ready to make a decision on a property, whether that's a current client or a brand new client coming in, it's going to be at first come, first serve basis. As far as how long the wait will be, that's largely determined by how many properties we have available, right? How many clients are at that point where they're ready to make a decision. So it comes down to supply and demand. We don't want a waiting list. I would love for there to not be a waiting list for all of us. So as quickly as we could build enough homes and get them close to the closing, to the finish line so we can make them available for you. If we had all of those built like they're in construction right now, there would be no waiting list. So we're not setting it up like it is a predetermined, there will be this amount of time, because we're trying to, you know, eliminate the waiting list for all intents and purposes. But the point of me sharing that with you guys is that just looking at the inventory we have today compared to the number of homes that we sell on a monthly basis, and knowing that we don't have as many coming down the pike that will be completed to satisfy that demand, there is going to be a waiting list. I don't know if it's going to be 2 weeks from now or 2 months from now, but there will be a waiting list. And that's what I want to equip all of you with, that knowledge that, again, if you're there, you're just saying, I don't know if it's right now or in 3 months or in 6 months, have that conversation with your spouse, with your family, with my team, and say, okay, let's take advantage of it now versus getting excited about it in 6 weeks. And then it's just kind of a waiting mentality at that point.
Got it. We got another good question here from our boy, Hervé Francois. He asks, as a clarification, this buyer's credit happens when the house rents for less than what the original stated rent by your property manager? I didn't say that correctly. He's asking clarification. Is this happening because it's renting for less than what your property manager said?
It's a great question, Hervé. Thank you for giving me the opportunity to clarify, because this is something that is a little unique. So it's not that this property is under rented. This happens when the house has been rented, and it has been rented, let's say, for 1 year, 2 years, 3 years. And then that rent appreciates from the time that we rented it last in JWB's own internal portfolio, right? We of course want to rent it for max dollars, just like we want to rent it for you for max dollars. So we rented it for what the market was bearing. And the last time we signed a lease or a renewal was probably 2 years ago, I'm estimating. Well, since that time, the market has appreciated since then. And so now when we're selling this asset to you, we want to sell it to you for what the full ability to generate a return is today. So it's not that it was under rented. It's just that time has elapsed and the market has appreciated for rents. And so today, when the client who buys this property, we want it to be performing just as the market would perform for them today, as if they were buying that asset. I think it's cool to show just the numbers of how we come up with that buyer credit and how it would affect your returns. And we've got the evaluation up here. Let's go down that path. Okay. So this is like the internal conversation JWB has when we're pricing an asset and we would decide if we're going to do a buyer credit. Okay. And I want you to see how it's a win for everybody here. Okay. So we know that our assets need to sell at a return on investment of somewhere between 7 to 8% based on what the market dictates right now. That's right now, this one is at 7.16%. Okay. We know that the market value of the home is $290,000. That's what everything is selling for around that property, $290,000. Okay. But the rents, and Pablo, if you just go a little bit to the left here, you see that row 25 where it says rents are equal to $1,668. Well, we have a resident in place that we have a signed lease with, that we've been managing this home for years now. We have a great relationship with them. We have a contractual agreement, but the rents are not at market simply because of the time that has elapsed. So let's do 1668 minus 131. Let's see what that is. 1668 minus 131. So the actual rent on this property right now is $1,537 a month. All right, Pablo, go ahead and type in $1,537 for the lease. Yeah, the lease amount there.
So 1,537.
Mm-hmm. So now let's go over to returns. So JWB has to sell the property at market value. Our current rent amount is $1,537. But if we were to bring this property to you, it doesn't meet our standard because your return on investment potential is only 5.52%. So this isn't an asset that I can bring to you. And this isn't an asset that we can sell at that point. So then we say, okay, well, how can we create a win for the resident, the client, and JWB here? And we say, okay, well, it makes sense then for us to bring the market rent, give a credit to the new buyer equal to what market rent is. And so the rent goes up to $1,668 based on what we see the market rent for that property being, right? Yep. That, and if we change that again, right, you can just go back and undo it, right? And Lee in the chat says, yeah, and it's a negative cash flow. Exactly, right? Before we do this buyer credit, it wouldn't make sense. This isn't an asset I can put our JWB name behind at that point. But when we issue that buyer credit, now look, it's positive cash flow and the returns are right in that 7 to 8% window, which is where we need to price our assets. And now the win for JWB is now this is an asset that we can sell as well, which is right now, the more assets that we have to sell, the better, because this is on the heels of me talking about how there's going to be a lack of inventory and a waiting list coming down the pike. So just wanted to get into the numbers so everybody can kind of understand how there really is a triple win here. And the third win is the resident. The resident still gets to stay here. We don't have to disrupt anything and everybody wins. So hopefully that provides a little bit more clarity about how we get there.
Yeah, I thought that was a great exercise. And by the way, you're off the hook because Madison found out that the lease ends on March 23rd, 2023. So in a little bit over a year, that lease ends and then it goes back up to market rent, right?
Madison for the win. Absolutely. And that's really important to point out because, Pablo, when do you receive your buyer credit?
When I sign.
When you sign, like when you close on the property, right? If in a year that resident renews again and it goes up to market rent, it's not like we pull back that buyer credit, right? The new rent you get, which would be up to market rent, would just be in addition to. So you can really win on buyer credits. Doesn't always work out that way, but at least, there's some upside there too, which we haven't really identified in the past.
Cool. Makes sense, man.
There
you go. And Ken Moline, patriarch of the first family, says, will folks on a waiting list have a selection of 3 or 4 homes?
Great question. So we are limiting the amount of properties folks can purchase to 5 properties. So that will be out there. And that will be when the waiting list happens. There's not a whole lot of clients that buy more than 5. So that was kind of done by intention, right? We don't want a, hedge fund coming in here and wanting to buy this inventory and buying all 40 at one time. So most of our clients buy 3 properties, 4 properties, 2 properties, somewhere around there. So probably not going to limit most of our clients from buying the properties that they want, but 5 would be the limit.
Okay, sounds good. We haven't done a lot of this whole guest investor without a guest investor other than me, who's normally the co-host. So I don't really know kind of like where we want to go here, GC. I know I haven't really gotten a lot. This has been mostly what the POTW used to be without a guest investor. It was just great questions from our audience and we got to answer it. If you were to ask me kind of like what I'm looking at when I look at this property as a guest investor, the first thing that really comes to mind is this idea that the homes that I bought last year were significantly less money, right? Like the overall price point was less. The cash flow was a little bit more, and the total ROI was almost right there, maybe a little bit more. But kind of when I'm looking at this thing, and I am, as you know, I am, right? Like I am currently in a buying cycle, trying to get my third property. And where my head really goes of what I've learned the most is the stuff that you teach, right? This idea that this $51 per month is just kind of like ticket to the game. I'm not coming out of pocket. I'm making a little bit of cash flow, but I, as a 41-year-old person, I'm in it for the long run, right? Like I know that as my debt pay down, right? As my tenant is paying down my mortgage, this $51 is eventually going to turn into, this top number of like having it fully bought out and potentially much more since rent's going up bananas. And that my total ROI over here is going to start at this 7.16% and maybe slightly more because I'm probably looking to put 20% down and just a 25% suggestion. But what I'm betting on is this idea that if I hold on to a full market cycle, this 0% appreciation rate is no longer going to be what I'm actually looking at. And I'm looking at like the historical appreciation rate of Jacksonville, which is now 4.6%, right? And when I'm looking at my assets, I pop in this 4.6% combined with this financing total ROI, and the magic of the property of the week happens. And, this thing pops up to like 24.66, right? So me, frankly, I'm looking at cashing out an old IRA maybe to get into this, because from every other asset class that I've been learning about in the market and whatnot, yes, I've hit on some individual stocks, and I keep that as like maybe like 5 to 10% of my investing is kind of like my gambling money for upside. And that's going into crypto and individual stocks and, stuff like that. But for the safe part of my portfolio, I don't know really of any asset that is offering me more than like 12%, 14% for something really safe. And this 24.66 just seems to me like the best place to put the stuff that I want the lowest risk on, that I want the highest return rate on. So that's what I'm looking at, right? Is this idea of leverage, which maybe you can explain.
You dropped a lot of really good things there. Before we go into the idea of leverage, let me just kind of synthesize what I think I'm hearing you say, right? Mm-hmm. You're looking at your overall portfolio, and there are parts of your portfolio that you're going to take more risks on and expect higher returns on. And they're probably more fun to invest in, right? Sure. Those are things like crypto is more like gambling, right? To me, it's like going to Vegas and, sitting down at the poker table or putting on black or whatever you want to say, right? So, and there's a place for that. Like I like to gamble every once in a while. I'd go there with some friends. It's fun, but I understand what I'm doing, and I understand that that's not my overall portfolio investment strategy. But, for many investors, they only have two options. It is more risky and more volatile. For many investors, it's the stock market is their go-to place. Now, Bitcoin and crypto is becoming an opportunity for folks. So they may go there, but those are more volatile, riskier assets, and they expect higher returns on investment. And that's what attracts them there. That's not why people invest in rental properties, right? People go to rental properties as an alternative to bonds. So what I heard you say is, I'm looking for a safe place. I'm looking for a place that's consistent, that still earns a high rate of return, right? When you compare the rental property investment to bonds, that's where it really stands out, because you get monthly income like you do with bonds. You get preservation of capital, which is what you get with bonds. But especially when you understand how to use smart debt effectively, you still can earn sizable returns on investment. So all of that being said, it sounds to me like you had been looking for an alternative to bonds, and this fits nicely with that for your portfolio. Did I get that right?
I mean, bonds, dividend stocks, ETFs, whatever you want to call it, man. I don't see anything out there that really makes me feel relatively certain that I'm going to be getting more than 20%, like on my money.
Well, 20% is a high hurdle to hit no matter what you're doing.
Yeah.
For your safe money out there, right? The money that you like, most people have some that they're like, all right, this has got to be here, right? Preservation of capital. Like, what would your return expectations be for like preservation of capital?
Well, that's what I'm saying, right? Like for me, like super safe money, I have a hard time thinking that I can expect more than 10%.
Yeah, absolutely. For most investors that are looking for super safe money, right? They're trying to beat inflation.
Yeah.
Which is harder to do now. That's almost 10%, by the way. you got to be up to like 8% to beat inflation right now. But most people, for super safe money, their options are, a CD, right?
Yeah.
Keep it in the bank, super safe, right? Anytime they would go into an ETF. I mean, that's typically too risky for a lot of folks, especially as folks are maybe getting older and maybe not having another income source coming in, right? You're still a young buck. You got a lot of active earning years. We've been doing this. We've been running together for years now and doing the show for years now. And it wasn't always this way in the beginning, right? Like you didn't see this asset this way. Can you take yourself back to 2 years ago, 2.5 years ago, and remember what that was like, and then help people see what was the trigger for you where you're like, oh shit, I get it.
Man, the trigger for me was this little exercise we just did. This thing of leverage, right? Like that to me was a major trigger, on top of the fact that being in Jacksonville and having my beliefs on like where Jacksonville is going is also really, really high. Right. But the leverage piece was the big part, right? Because for the first year of you and I working together, you know how people say like you're the average of like the 5 people you hang out with, like income wise, I bring that average down. Right. But so like I have a bunch of friends that are accredited investors and invest in a whole bunch of stuff that I can't. And when I'm like putting this in front of them, I'm like, man, I got this client. It's the best, like this stuff is awesome. And I want to buy it. They're like, yeah, man, but why can't I just like do this like syndication deal for 12%, 14%? Because they're comparing it to that non-leveraged, money piece, which like we said was when at the time we were putting up like 9 to 10% stuff. Right. Mm-hmm. So they didn't really get that part. Once I started understanding this leverage piece, the idea that I can put in 20% on a property, and now I get the appreciation of not just the 20% I put in, but the appreciation of the entire piece of the property. And I am very bullish on the idea that long-term Northeast Florida real estate is going to do very, very well based on everything that I'm seeing. Recognition of an urban center that has yet to really tip and is about to tip. That's what really drove it home for me of, wow, this is really the place to be. And then the urgency is, dude, stuff's going up, man. Like I'm seeing it, right? Like I am really like working hard to not freak out here and not think that I'm not going to be able to get my third property, because I want to do it ASAP before the interest rates goes up and before prices continue to go up.
Yeah. Bro, thanks for sharing all that, man. Just thanks for being real. Like the value that you bring to this community just by being you and being open and honest and transparent in your journey. I just really appreciate you. It's awesome, man. It's great.
You changed my life, buddy. So I appreciate your red back. So before, I know that you're going to do the This Is Your Life, Pablo Gonzalez. Before that, Joseph has a question in the Q&A, and I want to ask it. So because I have the same question, Joseph asks, what's the cost to move from an IRA to invest in real estate? And maybe you can explain non-recourse lending, but I'm literally thinking about taking the money out of the IRA to put it into real estate.
Well, I've got an idea for you specifically before we do that, but let's talk about what the cost would be, right? So the way qualified funds work, an IRA is a type of qualified fund, or a solo 401k, or your company sponsored 401k plan, right? You can't take that money out and withdraw it prior to age 59 and a half, or else you get a 10% penalty. So conversely, you can take that out and then you would just incur a 10% penalty. And some people do that and they see a better return on investment because that allows them to take advantage of an asset. So, but if we can construct a plan to where you can use that money in your qualified plan, your IRA, your company sponsored 401k plan, or your solo 401k plan, or your 403b, or any of those. Well, let's try to do that without you having to incur the 10% penalty, right? That's the goal there. So Pablo, for you, right, talk to me about your situation, that why, the IRA that you have, about the retirement funds. If you don't mind, we can kind of go into it and we can try to construct a plan where you don't have to take that 10% penalty and still be able to use the funds to buy the property.
Yeah, man, I'm happy to talk about that. I probably have like a $250,000 in kind of things that I've accrued from the beginning of my career and multiple ways that is sitting there. I'm not really contributing much to it year over year right now. In fact, zero year over year right now, because I'm an entrepreneur. I'm putting all my money back into my business. I'm building my business. So it's just kind of sitting there being managed by someone. Hasn't really done particularly well in the last 6 months, right? And yeah, it's just there. And then Marta, my wife, she's got a 401k with her company, but she's just now starting to fill that bucket because, she is foreign and it took her a while to get up to like a good salary level here in the United States. So she's got a company sponsored 401k working for a corporation. It doesn't have too much in it right now, but we do have this kind of like $250,000 of IRA hanging around.
Cool. So, and those have come from past companies that you worked for, right?
Correct.
They were an employer sponsored plan at one time. You left those companies and now were they transferred into just an IRA that you own, is maybe held at one of the big companies like Fidelity or whatever?
Correct.
Am I understanding that?
Yeah,
Okay.
something like that.
So the cool thing for you is that because you are no longer, your 401k money is no longer with an employer, like you're not an employee of that employer anymore, you have incredible options for where you would like to use that money, right? You could buy you could take your $250,000 in various IRAs, and you could use that to then go and acquire real estate right now. You would not have to incur the 10% penalty. All you'd have to do is transfer that from the custodian, being, call it Fidelity or whoever you have it with. They don't allow you to do this. They don't allow you to invest in real estate. But if you just change your custodian from, call it Fidelity, to a NewView IRA or an equity trust or another self-directed custodian that does allow you to invest in real estate, boom, there's your capital to invest in your third property. And you do not have to take that 10% haircut.
Okay. So that would be the non-recourse financing.
We could go non-recourse financing if you'd like. You don't have to use non-recourse financing though. So let's kind of separate non-recourse financing from buying the property.
Okay.
All right. Let's just say that you have $250,000, right? And I'm not saying you're going to do this, but let's just say that you want to take all of that and put that into a rental property or your third rental property. You would take that money, which is currently housed at your custodian of Fidelity, and you would just transfer that, just like you were transferring it from Fidelity to Schwab or whoever to the American.
I get that part.
Yeah, you're transferring over to, call it NewView IRA.
Yeah, I would go with NewView for the record. Go ahead.
There you go. I have my money with NewView. So you're there. Now you've got, call it $250,000. Well, you could make a separate decision of how you're going to invest that $250,000 in your rental property. You could buy it all cash, right? Which may be the play. Or you could then take that $250,000 and then get non-recourse financing. And instead of buying one property, you could buy 2 properties with non-recourse financing and do that. So 2 separate decisions. You can go whichever one is best for your goals. But the big thing here is, regardless, like if you wanted to get your money out of the stock market and to buy that rental property, and it was a wise decision looking at everything, you could do that without taking the 10% haircut. Easy.
Yeah. I guess I don't remember why you talked me out of that the first time. Or you didn't talk me out of it, but you gave me enough information that I was like, no, I should probably do this with conventional funds.
So buying outside of your retirement accounts is better than buying inside your retirement accounts from a return on investment perspective. In fact, let's go take a look at how it would actually play out.
Okay. What, show the property?
Yeah, let's show the property, right? Cool. And we'll assume that you're buying and holding for a long period of time, like you are. right? If you look at conventional financing there, your return on investment, if you're buying for a full market cycle, is upwards of 25% because of the power of leverage, because you're only putting down 25%, right? If you buy that same property in your retirement accounts and you bought it in cash, you did not use non-recourse financing, you didn't use any of that, right? Your return on investment is 10%. It's the same property, same rent that's being collected, but the difference is how much you're putting down, right?
Got it.
Non-recourse financing is inside your retirement account, but you have to put 50% down, right? Instead of 25% down. So if you have a choice of, and there's all things are equal, you can decide to invest outside of your retirement accounts or inside your retirement accounts in rental properties, choose outside of your retirement accounts, right? Another question might be, well, why would I choose to invest inside my retirement accounts? Well, compared to your other options inside your retirement accounts, even though rental property investing is not as good as outside, it's still probably better or maybe better than your other options inside your retirement account. There may be a value to diversify, right? Your other investments inside your retirement accounts might not be earning 11% returns on investment. So there you go. Does that?
Yeah. Yeah, that makes sense. That makes sense. And I'd love to get kind of, I'd like to move into the overall picture. So I get it. And I think I need to look at that equation. And I think I need to just move into that new view thing and be able to like have my own money and do whatever I need to do. So that makes a lot of sense. Plus, I think private lending is probably a good option. As far as answering Joseph Devine's question of what's the cost to move from IRA to invest in real estate, it sounds kind of like it's like there's no like real cost in moving to a solo IRA, that you can do. And then it's just like, what are the exact things that would be best for you? Sounds like that's a good, Joseph, if you go to chatwithjwb.com and talk to the JWB team, they're going to be able to like dive into your situation, kind of like Gregg just did for me, and help you work that out.
I heard financially why this was something that was attractive for you. Like I understand now where it fits in your portfolio, right? An opportunity to have consistent cash flow and whatnot, but also earn a return on investment. That upside clearly is important for you as well. But take me a step farther. I always love to find out why you're investing beyond that. Like, what is your why, right? Can you take me to like what you hope this portfolio will accomplish for you and Marta?
Yeah, man. Options, dude. Right? Like, we're not going to have kids. We very much value lifestyle and options. And if we can get to a point where we're making $5,000 a month on cash flow, that really opens up a whole bunch of options, right? That is we don't necessarily have to make too much money to live relatively well in Jacksonville right now. If we make even more money than that passively, it's even more options, right? So I would say that's how I sum it up. And honestly, man, like the reason why I want to move right now is this idea that I think Jacksonville is, from everything that I read, it's this like supernova city that's about to really get expensive. I haven't bought my primary residence, so I know that I need to take part in that upside of Jacksonville right now in order to maybe one day live at the beach like you.
Well, I have a feeling that we're going to be doing a lot of surfing together over the next full market cycle. And it sounds like that's what it is, right? I can relate to everything you're saying there, right? Like it is about, the options. I can control my time, right? Like I love what I do on a daily basis. You love what you do on a daily basis, but there are other things that I love to do beyond this as well, right? And I want to have the freedom of choice to be able to spend that time however I am. And I understand the way the world works is I got to have income coming in order to be able to do those things. So I get it, brother. That's awesome, man. Let's jump into this. Thank you for sharing your why, man. This is a little glimpse into what you shared with our team when we started to build the portfolio for you about a year ago here. And we can see a lot of these same concepts, right? Diversification, retirement, security of passive income, all allowing you to do what you want to do with your time and to know that you have that secured passive income stream coming in. When we built the plan originally, we talked about a monthly passive income goal of 10,000. And then we broke that down into a number of properties you need to put in your portfolio in order to get there. And so that broke down into 14 properties overall. And right now we are at 2 properties and we're on our way. We probably here for a year to achieve current milestone. We have TBD. This is, year to achieve current milestone can be a tougher one. So sometimes we just let clients think about that for a little while. And I'm sure that's what we did with you. And, the next time we have a portfolio review with you and your client service teammate, I'm sure we'll kind of nail that down. And it's very often that we kind of trim up a lot of the plan, right? It's not set in stone. It adjusts. So that's something that we have to look forward to. And then, I know that you've been mentioning for months now that you're looking for your next purchase. Well, it's really cool for you to see that your date of next purchase for what we all talked about. Geez, probably at the end of your second purchase, you're like, I want to target December. So been thinking about it for a while. And then we're always here to make sure that you get to see this. You can log in for any client who is not public. You can log in anytime you can see this. And it's a great reminder for all of us of why we're doing what we're doing. All right, my man, here are your two properties. Here is 5542 Minosa and 7171 Lucky Street. All right. So I always love for people to get just a glimpse into what the rents have done on their properties. So I see you smiling over there, brother, and you should, man. Look, when you bought that property on Minosa, we told you to expect $1,000 in rent. Again, it's only been a year here, but we actually rented that property initially for you at $1,025. So a cool under promise and over deliver moment. And here's the big thing. Everybody loves cash flow, right? I love cash flow too. Well, cash flows are evaporating. They're going down, right? When you can do something like rent a property out for an additional $25 a month, that's $300 a year of additional cash flow, right? The property we're talking about here on Locust, which is the property of the week here, that's going to have $50 a month of positive cash flow. If we can under promise and over deliver and rent it out for an additional 25, that does a ton for your overall cash flows and your return on investment. So a little bit of under promise and over deliver can really create a lot of upside for all of our clients. And it has for you, brother. And speaking of Lucky Drive, that was even more upside. We told you $925 on the eval. It came in at $1,000. So additional $75 a month. You combine both of those things and your additional cash flow each year is $1,200 just from over renting from what we conservatively put on the evaluation. Pretty cool, huh, dude?
It's cool, man. I'm getting excited to see my final figures.
Yeah, we're going to get there, man. One other little tidbit that I was just looking at your portfolio for Lucky, the rent is increasing to $1,050 a month beginning next month. So it just keeps getting better there, bro.
Lucky indeed.
Lucky indeed. Well, let's take a look at your highest return property. That is Minosa here. So just over the last year, roughly here, you're at 11.23% annualized lifetime returns. And that does not include home price appreciation. And here's something else to consider. When you bought your property, you had that buyer credit right off the bat.
That's right.
Your buyer credit was somewhere around $6,500, if I remember correctly. Well, JWB has covered $900 in maintenance cost under that credit so far. And that $900 has not been factored into the return on investment in this calculation. So that would actually just jack that up a little bit more. The really cool thing is you still have $5,040 remaining of construction credit. So the next $5,000 of costs that are coming from a maintenance perspective are covered under this credit, which is really, really cool for the consistency of your returns going forward.
Love that.
That's awesome. And then your lowest lifetime return, right? You got two properties. One's got to be the highest, one's got to be the lowest. This one on Lucky Drive, right? You're at 4% annualized lifetime returns. Now I was looking at this and I'm like, are people thinking that this is underperforming? Like, what do you think? Do you think this is underperforming?
I mean, I don't get the sense that it's underperforming, right? Like, full disclosure, I thought that the other property would be the one that might have underperformed because it was in the eviction moratorium for a while. And I knew that, we recouped a bunch of fees and stuff like that, but I thought maybe there was still a chance of that.
Yeah. So let's go back to Minosa, right? There were months here where you didn't receive rent, right? And then our team working through a lot of the charities and the state programs to be able to recoup rents from folks who were negatively affected by COVID, we're able to collect all of that rent. So your rent has been paid back in full.
Yeah.
Right. Took a little bit of time to get there.
Yeah.
And now look at your returns, 11.2%.
Sweet.
Really with a little bit more coming in the form of that $900 credit there.
Yeah.
And the one on, go ahead, bud.
Oh, I was just going to say, then this like Lucky one is more surprising, right? Because you saw that I had like more cash flow, but this analyzed lifetime return, that's just not something I really think about, right? Like I'm not really thinking about this, like the overall return in the short term as much as cash flow. And the cash flow from Lucky has been good the whole time, right? Like for us, it's, an extra couple, 100 or so bucks a month. As I like look into my bank account, I'm like, man, like we're more positive on like our savings than we were before. Like it shows after a little while, right? So I didn't really think about it this way.
Yeah. And both of those experiences matter as far as determining the success of the portfolio, right?
Mm-hmm.
The cash effect and like, did good things happen or did maintenance costs or negative things happen? Like we feel that very much. We tend not to think about how hard our money is working for us in totality, right? Yeah. So this report just kind of, again, is that scorecard. It's that level setting for us to look at how hard our money is working. And the other point I wanted to reach out here or talk about here on Lucky is that it's very normal for it. It takes a year-ish, somewhere around there, for you to get close to your return on investment returns, typically.
Yeah.
And the reason is because in the first year, right off the bat, you have your tenant placement fee. And it takes you roughly a year for you to earn, receive that positive monthly cash flow and not have those fees coming for you to actually get your returns up to what we would expect them to be. So you're actually just kind of like you mentioned, it's performing like we would have expected generally right there on Lucky. It's just, it is a little bit lower, largely because it has a negative cost right off the bat for tenant placement fees, as all properties do.
Well, tenant placement fees and like closing costs and stuff like that, right?
Well, tenant placement fees are different than closing costs.
Yeah.
Right. Your closing cost is part of your initial investment.
Okay.
Tenant placement fees would be your ongoing, annualized return. Right. Okay. Great question. We never had that one asked yet, but yeah, it would be noted separately.
Cool.
All right, brother. Here's the big reveal, man.
Let's go.
For your 5 profit centers, Pablo Gonzalez, here's what we're looking at. A year of a JWB client experience here. Your net rental income, just about break even, right? Which again, is right about what I would tell any client to expect after a full year of ownership, right? Performing like we expect to, you're going to have a cost right off the bat, which is your tenant placement fee. And then for the remaining months of the year, you're going to have more in positive cash flow than we told you to expect in order to offset that. And you're going to be right around break even after your first year. So I look at that and I say, that's normal, man. Tax savings, $2,335. We love that. That is the savings that we get simply because we invest in this asset class and we get to write off depreciation, which is what we love. So we have to pay less in taxes for the income that we earn. The third profit center is principal pay down, $2,979 of your residents paying your loans off for you. How much do you love that, man?
Love it, man. It's awesome.
So cool. Yeah. One of the reasons we love our residents, well, one of the reasons we want to treat them like gold, it's because they help us pay down our loans and get us to our financial goals. And here's the big hitter, right? Total home price appreciation, $46,534. We put these numbers out here and sometimes it just doesn't even feel right. Like it's such a large number. What's your feeling when you look at the amount that your properties have appreciated?
I mean, it's insane, dude. Like I put in, all in all, I guess I probably put in like 60 grand, right? For like the 20% plus closing costs for both houses. And to think that a year later, I've already almost like paid that back in appreciation is nuts, right? Like 3/4 of that is pretty crazy, man. And, it's kind of what everybody was feeling, right? Like market's going up. I think it's going to continue to go up, right? Months of inventory is still under a month. Seeing what the dollar amount equates to is really cool.
And then inflation hedging, just an update here. The consumer price index just released is now 7.9%. That means the inflation rate is growing. Inflation is a thief. It erodes your wealth. If you have money just sitting under your pillow or in a bank account or not earning 7.9%, you're actually losing. That's why you need to be investing in hard assets that are a hedge against inflation. And my boy Pablo is, and I hope you all do too. All right, you ready for the big reveal, brother?
Please.
All right, man. When you made the decisions to invest, we told you to expect an 11.7% return on investment. Your actual return on investment, including all 5 profit centers, including the cost to potentially even liquidate if you would decide to do that, right? We include those costs. Your actual return on investment is 27.5%. Congratulations, my man.
Not too shabby. Not too shabby. That's cool, man.
Talk to me a little bit about how, and I know you're a year into this, right? And we're early on in the journey here, but talk to me about how this you see this change in your life?
How I see this change in my life, Greg, I think it's exactly what we talked about. I think it's a ton of options, right? Like having these two properties and this appreciating market and having this like equity that has accrued in just 1 year, right? Like in just 1 year, I've accrued $50,000 plus of equity. That's stuff that I can leverage for other things. I really see this as like preservation of options and seeing those numbers in front of me in just barely a year into this investment that I know gets better with time just makes me super, super pumped about the options, like about what the future options are going to be. And I'm just super pumped about it, man. Like, and to see this right now, like if I were to liquidate right now and I made 27.5%, I really do want to be like, see, Dad, look, I told you, bro. You know, like it is kind of like a beat my chest moment because it's an unconventional approach, right? Like this not your average investor thing was very, very real to me, right? Like my smartest guys in the room, corporate lawyer friends and corporate finance friends were just like, nah, man, you know, like that is a risky thing. And my dad, who I think is the smartest dude in the room too, is like, yeah, you know, like I didn't have a lot of support, but like lucky for me as the host of this show and seeing behind the scenes of the type of company that JWB is and talking about it year after year and, you know, like week after week and just really buying in on this thing. Like it's very validating, man. Like I feel great.
You talk about it being validating for you, man. I just want to tell you how much it means to me to have one of my best friends trust me.
Makes sense.
You know, like that's the currency, you know, when a new client comes in and they trust us, right? That's the currency that matters, right? It's just such an awesome feeling and responsibility that we love and that I love. And I appreciate your trust, man. It's been awesome.
Right back at you, bro. This has been an incredible experience all the way around, from the ability to be a part of this community that has grown and like prove this thesis of we can build a community based on a Zoom call.
Yeah, right.
To like changing my financial future, to understanding the right way that you're supposed to build a business and core values and mission driven stuff and, you know, all these different things, man. Bro, I'm glad we get to have this moment. I want to thank the community, right? Like we've had 40 plus people here most of this call. Thanks for listening to my journey and whatever, and asking these great questions. I'm pumped to have new members coming in, like Joseph and folks that are tuning in for the first time. It's great that you take an hour of your day in the middle of a Thursday to hang out is really what we most treasure, because it's all built through you. If you're listening in the podcast and you're listening on the radio, join us, get a nickname, be part of the fun. And I'm going to be in Jamaica next week, man. I'm taking my first vacation in like 3 years with the lady, but I know that you got a couple guys from Fortune Builders joining you to teach us about how to build your own real estate empire. You want to talk about that?
I do, man. And first of all, I'm so happy and just glad that you are taking this time with Martha. You guys deserve it. You deserve it. We have two incredible guests, two of my best friends in real estate here. We've got JD Asajian and Jeff Rutkowski from Fortune Builders, who are going to be teaching all of you how you can build your own real estate business. So it's going to be a little bit of a diversion from the passive side onto the active side. And it's also going to be talking about strategies where you can do both active investing and passive investing. So wherever you are on the spectrum, active and passive, or just passive, this is going to be an incredible opportunity to learn. And this is a team that I've been investing with for well over a decade, and a team that I learned how to do real estate from in the very beginning. So it's going to be amazing. Next Tuesday on the show. We'll see you next Tuesday.
All right. Don't be an average investor, y'all. Show up for GC on Tuesday. He needs it. Bye.